Hi everyone, welcome to today's video, and let me start today's video by talking about Nifty 50, and I will show you some really interesting points. So take a look at this point number 1. This was 2008 financial crisis issue and the markets corrected quite a lot. So this is a very clear correction. Then the second correction came here. This was 2016 and there was a lot of trade wars that were being fought during this period between US and China. So again, the markets corrected quite a lot from a time perspective, that the markets underwent a lot of sideways movement. Now comes point number 3. This is the COVID period, fairly recent period, and again a very clear fall in the stock market. Now we are sitting at this point number 4 and the markets have danced around and they have almost come back to their previous high. So therefore, a lot of people are worried and they are saying that, you know what, this is a retail trap, that the markets now are going to undergo a severe correction and whatever losses people are going to make in the market right now, that is going to stay intact for at least 2-3 years, and it will take years and years for the market to recover. So I'm going to help you understand the historic context and share my perspective whether or not such a scenario is going to play out, why it will play out, why it will not play out. If you understand this entire macroeconomic game, it will help you not only understand more about economics and finance, but it can prove to be a great opportunity to either sell your stocks now or buy a lot of stuff, depending on whichever direction you are taking in the market. Also, many of you ask me that, Akshat, do you invest in US stocks and which app would you recommend for US stock investing? I would highly recommend Vested. I have been using it for more than a year and I have created several vests that you can go and check out in case you are considering to invest in the US stock markets. I have also explained the pros and cons of investing via Vested in the comment and description box. So you can go and read it and then make a final call. So let us get the discussion started and I will explain the entire story in 5 simple points, giving you some historic context. So first and foremost, this entire debate of we undergoing a recession stems from the 1970 crisis, because there is a lot of parallel between 1970s, what happened in the economy back then, and what is happening in the economy as of now. So just to set some context as to what was happening in 1970s. So it was a period when US was undergoing a lot of political turmoil. For example, President Nixon politics was criticized by a lot of people, participation in war, and there were a lot of economic related, unemployment related issues. On a world level, we were undergoing a problem of high inflation. Oil prices were really high. The world was not working together. Some European countries were having supply chain crisis, especially around steel industry. So it was a period when the world was contracting. High inflation, high unemployment rate, supply chain issues. And now you'll say that, you know what? Even now in 2022, we are almost in that situation. High inflation, yes. War-like situation, yes. The world is going through supply chain crisis, yes. So a lot of parallels between 1970 and 2022. And what happened in the 1970s? That the stock market corrected by roughly 50% in a matter of 20 months. So that is how sharp the stock market fall was. This was triggered due to high inflation constraints. And as the Paul Volcker, so he was the Fed president during that time. So he kept on increasing the interest rate and the stock market kept going down, down and down. Now you'll say that, Akshat, I just read the news in the US 3 days ago. Stock market fell by 4%. Why? Because of the interest rate issues that Feds are going to increase the interest rate. So are we looking at 50% stock market fall from this point? In order to understand that, we will move to point number 2, and here you need to understand the concept of different type of market recoveries. Because back in the 70s, there was something called as U-shaped recovery. So U-shaped recovery is a very much long drawn recovery period that undertakes, and the 1970s were called as one of the tragic periods in the American macroeconomic policy making, and I'm reading it from the professor's report. So this was a commentary that was done by Wharton professor Jeremy Siegel, and he said, this is the greatest failure of American macroeconomic policy in the post-war periods. So we are talking about the post-World War I, World War II period. Now, why did he say this? And this is the GDP data from that time. And you will see that during a 20-year period, there was hardly any growth in the world. So the stock markets crashed somewhere in 70s, and till 1985, there was hardly any recovery. So this brings us to a core question that, hey, is something similar going to happen in 2022, that, hey, crash comes now and we will recover in 2035, 2040. I'll be too old by then. So what will I do by investing in the stock market? Okay, so let us understand it from a macroeconomic viewpoint. And for that, you need to understand the concept of recovery. The 1970 recovery that took place, it is called as the U-shaped recovery of the stock market. So in a U-shaped recovery, what ends up happening is that the market takes a lot of time for recovery. On the flip side, there is something called as V-shaped recovery. Now, this is something that we saw in the 2020 period when the markets went down and they very aggressively recovered in a very short span of time. So I hope you understand the difference between U and V-shaped recovery. There are also different types of recovery. For example, K-shaped recovery, W-shaped recovery, and I'm putting the data here. You can go and study it. What I'm going to do is that I'm going to practically relate this macroeconomic concepts to the stock market. So what do you notice in 2008-9? So you will see that, hey, this looks like a U-shaped recovery. Now, what does this recovery look like? The 2016 one. It looks like a W-shaped recovery. And now we had a very clear V-shaped recovery. So just to complete the context, if we go back to 1970s and take a look at the recovery there, the U there would have looked something like this. Now, the important point and the important message that you need to remember is that how did we move from this situation when recovery used to take so much time to a situation like this where we moved from literally U to V? Because one argument that you can make is that, you know what, Akshat, probably 1970s, really bad situation. So it took so much time for recovery to happen. Now I can make the same argument sitting in 2020 that 2020 was a time that the world for the first time literally stopped. There has hardly been any such crisis over the last 150 odd years where the entire world was advised not to go out of their homes per se. The businesses stopped. At least from the gravity point of view, there is no reason why 2020 was a lesser crisis compared to the 1970s. So what exactly happened that now the world is recovering faster and faster, and in the previous days, the recovery used to happen slower. Okay, so for that, we will move to point number 3, where I'll help you understand the practicality of U versus V recovery. So my theory is that these type of U-shaped recoveries happen when the governments do not have a lot of control over the economics. What does that mean? I will explain that in a minute. And a V-shaped recovery happens when the governments have a lot of control over the macroeconomics. So now I'm going to systematically tell you that we live in a world where the government has complete control over macroeconomics. And let me show you some data around it. So the first data is regarding the inflation history of India. And what you will notice is that this is the 1970s period, this is the 1980s period, 1990 period, this was early 2000. And generally speaking, the inflation in the economy has gone down. Right now we are at 6%, but go back to 60s, 70s, the inflation used to be 20, 25%. Yes, the entire world right now is panicking that, you know what, very high inflation, this, that. But okay, go back to 1960s, 70s, check the data, and you yourself see that inflation generally has come down. So let me very quickly explain it to you as to why inflation has systematically come down. And there are two reasons for that. So the first reason is that how is inflation measured? So basically the government creates a basket of goods and they define whether we should put atta, dal, chawal in it or oil and gas in it, etc., etc. So they are the ones picking the items. And so these basket of goods are changed from time to time. So it's not as if that the inflation, the way it was measured in 1970, it remains exactly the same now. Government gets the flexibility of literally changing the constituents of things that create inflation in the first place. So this is reason number one. Reason number two has to do with macroeconomic and money printing. So what exactly is inflation? Inflation in very simple terms means mismatch of prices. For example, if there are too many people demanding this pen and I just have one pen, then of course I'm going to get very high rates. So this becomes a mismatch of demand and supply. What does government control completely? It controls the supply of money. For example, by moving around the interest rates and by printing more money, they can literally control the supply of money. And as a result, they can completely control the demand of goods and services that are demanded in a particular economy. Now, of course, I'm presenting a simplistic picture, but the point that I'm trying to drive home is that back in the 1970s, the government did not have complete control over money. For example, the Nixon government moved away from the gold standard post 1972. The concept of aggressive quantitative easing, which means printing more money and dumping it into the economy, it came after 2008 financial crisis. So after 2008, governments have realized that, you know what, we can print any amount of money that we need. We will just keep on rolling over the debt. So they just keep on increasing more and more debt. Now with these infinite powers, what is happening is that the supply of money can be increased whenever they want, and it can be decreased whenever they want. And this impacts the inflation number in the economy. So if right now in 2022, governments all across the world realize that, you know what, We are not comfortable with 6% inflation in India or 10% inflation in the US. They can completely bring that number down. Does it impact you, and what negative impact does it create? That probably requires a different video, because that leads to more high debt in the world and it impacts the poorer country the most. And if you want, I'll make a separate video on that. But to cut the long story short, what you need to remember is that this inflation in the economy is completely controlled by the governments right now. And here I'm not speaking about just the Indian government. Again, you can check the history of inflation in UK, and again you will see that same long-term trend, that inflation has come down quite aggressively and it has maintained a somewhat constant level over the years. Is that the right thing? Is that the wrong thing? Again, that requires a separate debate. But whatever is happening in the economy, one could argue that a large part of it is artificial. Now let me show you one more example which has to do with interest rate. Now interest rate means what? So you can see this from two arguments. That one is that you go to HDFC Bank and you are getting a fixed deposit rate that is impacted by interest rate. If government says that, you know what, increase the FD rates, then banks will have to increase the FD rate, and that would indirectly mean that interest rates have gone higher. So that's one way of interpreting it. Second way of interpreting this data is at what rate the government gets to borrow. Now you'll say, from whom do they borrow? So they are borrowing in a way from general public by printing more money. So that every time a new note is printed into the Indian economy, you and I are giving a loan to the Indian government. And at what rate governments have been borrowing from people? Okay, so again, take a look at this data, and what you will see is that interest rate over the decades have come down and down. So two situations have gotten mixed. One, government has complete control in terms of moving around the inflation number. Whatever they want to do, they will easily do it. Second is that they have gotten infinite money printing power at close to 0% interest rate. So if the interest rate have come down to zero, they can literally make any problem go away by printing more and more money and passing on the real problems to the next generation. So just to help you understand this concept, let me do a scenario analysis. So let's say that in 2023, the stock markets fall by 30%. What does the government need to do in order to bring the stock markets back up? They just simply need to cut the interest rate or print a lot of money. The moment that they do it, 2020-like situation will play out, that the markets will shoot up and a V-shaped recovery will happen. In 1970s, such options were not there with the government. Government did not have complete control over the economy. Now the entire markets can be moved just by manipulating the interest rate. So here is the most critical part that you need to understand from this video, that if the government does not want the stock market to fall by 30%, they are just going to play around with the interest rate and money printing, and they will bring the stock market back up. And in 1970s, the governments did not have that option. So now comes the fourth point, or the natural question, that hey, why is it that government is going to help me out? They do not probably bother about stock market participant. So what is the incentive that the governments have in order to boost the stock market? There are multiple reasons. First and foremost, if the stock market of any country is strong, then it indicates a positive governance. For example, many times you might have noticed that some leader won the election, stock markets went up, so everyone reacted very positively. And a nation's GDP performance, which the political leaders deeply care about. Now, second key point, that back in the 1970s, if you study the sociological or society-oriented reasons, those people, at least who lived back in the 1970s, they had gone through World War I, World War II, Vietnam War, so many negative wars. India had undergone an independence age. We had seen brutal partition. So politicians could be more truthful with people. But unfortunately, in 2022, we live in a world where if you and I do not get our orders in 30 minutes from Swiggy or Zomato, we start stressing. So our ancestors were very resilient people, but we are slightly more entitled. And what do politicians do, or what exactly is politics? Politics, in simple words, is pandering to the crowd. So pandering to the crowd means that they just want to please the crowd. Now we are a softer generation. We can't see a loss of 40-50% and not see a period of 15-20 years of growth. We will just throw away that political party. If you understand this simple point, it will give you a lot of confidence to stay in the stock markets. So third and finally, as I had previously pointed out, that governments have infinite money control power as of now. They can move the market whenever they want to move it. They do political pandering and appeasement of people, and people right now, they cannot take pain. 2020 was a painful period, and there is no reason why in 2022, 2023, we will see a massive fall, like 40-50% with a very U-shaped recovery. In case a fall happens, it will be quick and it will be a V-shaped recovery. So this brings me to fifth and final point, and there is a reward for all of you for watching the video up until now. Do press the like button though. So there are three important implications that you should remember. Point number one, please do not sit on the sidelines and keep watching the show. stock market will run and you will keep on imagining a 1970s like situation that, you know what, there is a 50% fall coming like 1970s. No, it is highly unlikely that such a scenario is going to play out in the first instance. Even if such a thing happens, the recovery will be sharp. Point number 2, whatever investing you are doing in the markets right now, there is a very good chance that the stock markets will go sideways, very similar to how it went in 2016. So from that particular perspective, you should hedge your portfolio. Do not buy overinflated stuff, at least till the point you see a very clear growth trajectory happening and a market breakout happening. Third and final point, when the games of macroeconomy changes, you have to learn macroeconomic investing. If you're not a macro investor, then you will keep on imagining that, okay, you know what, MACD, RSI I'll put and I'll make like crazy amount of money. I'll put some stop loss also and I will become world's best trader. Okay, in 2020, all the RSI, MACD, it kept on staying there it is. Technical indicators did not help you at all. People lost a lot of money. Second key thing, when the markets kept on falling, they did not take long-term positions. Again, they lost a lot of money. In 2021, when high inflation was peaking, no one was willing to buy stocks like HUL. They were available at huge discounts. I had made so many videos on it. Please go and check. The reason why I know this stuff is because I'm a macro investor. So I would highly encourage you to learn macroeconomics, identify what type of events will create an impact on the stock market, vis-a-vis not. I teach these concepts on my stock market course also. In case you're interested, you can study all these things in a structured format, or you can check some of my vests in the description box. At least that will give you some basic understanding of where to go from now. I hope you enjoyed this video. Please press the like button and I will see you soon.